Welcome to another Signal conversation. This one is a repeat conversation. We're not running an old one. We are bringing our friend John Dick from CivicScience back to help us understand what have become somewhat turbulent times. John is a serial entrepreneur with extensive experience in new business formation and marketing, host of a successful podcast, and a great weekly email newsletter, which is read by a who's who of business leaders, marketers, policymakers, and even celebrities. He also plays in a band called Moscow Mule, which I respect as an aspiring band player myself. Welcome back to Signal.
Good to be here, John. I think you read that maybe exact same bio the last time I saw you on stage at Signal in person. So maybe it's
that is entirely possible.
I'm due to update it, but it's great to be with you.
Well, if you were to update it, what would you add?
Oh man, I guess I don't know. My life hasn't gotten all that much more interesting. Still doing all those things. So yeah, we'll just ride with it. It's fine.
Well, a lot has happened since we caught up about 2 years ago. I'm curious, given what you do, which is, sample and ask questions of literally, I think, 1 million questions a day of consumers. What's on their minds right now?
What isn't, John? I mean, it's look, I think the sort of prevailing mood is frankly one of fear, anxiety. Look, uncertainty is just it's a bad thing for the economy. It's a bad thing for markets. It's a particularly bad thing for consumers. I've been, saying and writing this a lot the last several weeks. There's some just uncanny kind of eerie similarities to things that we see in our data that we saw in the early days of the pandemic in terms of how the consumer is feeling and how they're reacting to the sort of just sense of uncertainty, the kind of quote unquote unprecedented nature of what's going on right now. And it's, causing, I know we'll get into a lot of this, but just really across the board shifts in behavior and spending and prioritization. We're seeing, even this is a very direct correlation to the early days of COVID is just this consumers not even wanting to leave the house as much as we would expect to see them leave the house right now, even with the weather getting better and so on. So, it's just a strange time. I feel like the consumer would rather just know that the worst of the bad news is certain to come so they could adjust to it. The kind of will they, won't they state of things is almost even worse for them. And it's just manifesting itself all over the place.
So give me a few examples, let's say in online commerce or retail shopping. How are those behaviors changing?
Well, there's just generally a lot of pulling back happening kind of across the board. But I want to qualify that because, every consumer, almost like as unique as their fingerprint, prioritizes different categories of spending based on a lot of it has to do with just the sort of sense of emotional well-being. And this is a very, very consistent sort of post-COVID, post-pandemic stress disorder phenomenon we've seen is how consumers consciously and subconsciously view their consumerism as a gesture of self-care. So they prioritize spending categories that make them feel better or safer or more comfortable or indulgent, and they'll fight to the death to preserve their spending in those categories, and then they'll cut everywhere else. And that hierarchy of prioritization really varies widely across almost at an individual level, but certainly at demographic segment groups that we see. Now, a lot of things, of course, we're gonna see, shifting away from shopping in store and more shopping online. Frankly, if for no other reason than the internet's a deflationary tool, right? So people can shop for better deals online. We're definitely seeing pullbacks in certain categories of dining out. A lot of QSR, for example, is getting hit. But there's just so many nuances to it. You all may recall, if you saw my talk at the Signal conference a couple years ago, how much consumer confidence today varies by party affiliation, right? So we're watching Republicans behave differently than Democrats based on sort of how pessimistic they are at the moment. And of course, that's very highly correlated with, how much you support Donald Trump or not, and how much you trust that he's got some plan and that it's all going to work out. We're seeing differences in old and young, rich and poor, and so forth. And so it's very complex state of things, but I would just say the overarching kind of uncertainty and fear is the one thing we can paint a fairly broad brush across everyone with.
Is there anything you're seeing in the data that is doing better in these times?
Not really. Nothing that immediately comes to mind. There are certain categories of like prestige retail are continue to do okay. I mean, look, the higher income consumer just is able to spend more money now, and another kind of nuance or kind of a perfect storm of what's going on right now is when you have the combination of tariff concerns and tariff price concerns, which tend to hit middle income to lower income consumers harder because they're the ones that are expecting to feel the price increases that come with those tariffs. So that lower income consumer is feeling anxious and beginning to pull back due to tariff concerns. At the upper end of the income spectrum, you've got your sort of upper middle class to upper income consumer who's concerned about a recession, right? Recession's going to affect their stock portfolio, their home value, all these kinds of things. That it's interest rates aren't going to come down as you'd hope. So even that higher end consumer is concerned on a more macro level. So it's affecting their investment strategies, their retirement planning. They're delaying certain kind of like long trips that they might otherwise want to take, larger purchases that they're going to want to take. We're seeing things like, we're not the first ones to report this. We saw early signs of this in the early first quarter about people beginning to pull back on some travel plans. Now the airlines are all reporting significantly lower forecasts for the year. Going into 2025, we expected it to be a really good summer for home improvement and home renovations. That is all kind of falling off of a cliff right now, where the consumer is, lessening, or if not sort of delaying to potentially canceling to downsizing, those kinds of things. One of the big boosts that summer home improvement usually gets is from tax refunds that consumers get, right? Kind of those checks show up late April, early May. And that's one of those bigger things that and also travel, that we see consumers that have a windfall with tax returns tend to invest those things in. Now those same consumers are telling us, no, they're either going to save that money, use it to pay down debt, or use it just to cover household expenses. So there's not a whole lot from the consumer's perspective that I see as a silver lining. Any categories that are doing particularly well. I mean, you can see like dollar stores, for example, are starting to see some of those higher income consumers kind of trade down into their stores. So there may be, again, I don't know if that's a silver lining as much as it is sort of a, putting a finger being put in the dam to kind of slow the floods a bit. But no, it's hard to see. Now we can talk about from a business perspective where silver linings might be. So I'll ask myself that question. And
please do.
Yeah, sure. We forget it's been a good solid 15 years since we've been in a real honest recessionary climate. And I'm not saying we're there yet, but there's lots of reasons to believe we're on the precipice of one. And the consumer is feeling that, partly because they're being told to fear it. And so we kind of forget the playbook, right? There's a lot of people when we go see our clients, a lot of people in those boardrooms we're talking to didn't work there 15 years ago when there was a recession. They don't remember what it's like, right? And one of the things that we know to be very true, and maybe even a little counterintuitive, is the extent to which consumers, their switching propensity increases dramatically in times of gusty economic headwinds. And we're seeing it, even in categories where it's hard to switch, mobile carriers, banks, switching behavior, particularly in the mobile carrier space in the first quarter, was up 40% over the same quarter a year ago. The consumer it's a gesture of control, right? I can't control anything else that's going on in the world, but I can control the relationships I have with the vendors in my life. Part of it is, it costs money to switch your mobile carrier, right? There's taxes. You maybe have to get a new phone. There's penalties potentially you have to pay. But people were sucking those things up because they think it's going to get worse. They want to do it now so that they're maybe not burdened with as big of a monthly fee come August, September, October when it's worse. So it's a great opportunity for really smart marketers to grow share, to conquest customers of competitive brands, because if they're willing to switch their mobile carrier and they're willing to switch their bank, then they're willing to switch their razor, they're willing to switch their shampoo, their breakfast cereal, right? And so we know a lot of times CFOs want to kind of pull back on marketing expenses when things are uncertain and headwinds are blowing, but it's exactly the wrong time to do that, because the brands that are really smart about identifying their vulnerable competitors who have the most sort of adjacent kind of similar customer, it's the time to go after and play hardball and steal share. So it is a chance to be opportunistic from that perspective.
Have you seen anything in the data relating to that, that sort of desirable demographic known as youth or young adults, Gen Z, Gen Y, Gen A?
We only know about Gen Alpha by surveying their parents and what they're buying for their kids. So that's going to be more or less a proxy for how much those parents are spending on themselves at this state, right? Just how much disposable income they have and what they're doing with it. Gen Z, of course, we study obsessively. And I don't know if this is necessarily a good thing. We're not seeing as much of a pullback from Gen Z in terms of their overall spending. When we ask them about tariff concerns, that we just don't see that same heightened level of sensitivity to it. We're not seeing the same pullback that we're seeing, say, from millennials and younger Gen Xers and now increasingly older Americans. They're going to keep spending the same amount of money that they've conditioned themselves to spend. Which is, I think, great for retailers, maybe bad long-term because those chickens will come home to roost at some point. So they're taking on more debt. What we are watching is savings rates of Gen Z are falling off of a cliff. So rather than putting money away for, whether they're investing or starting to save for retirement, they're spending that money now instead of saving it. So I don't know if that's, like I said, maybe good for the retailers that are benefiting from those dollars, but certainly maybe not so great for the long-term economy. I will say, there is actually maybe one very small short-term silver lining, which is the 15 to 20% of consumers that we're seeing now accelerate purchases. Right, like since in the last 2, 3, 4 weeks, right? Goods that they're buying, expenses that they're making now because they know or fear that those things are going to be 25, 50, 100% more expensive. So we might see some in certain categories like electronics, home goods. We're seeing some kind of hoarding behaviors even. That's another thing that kind of harkens us back to COVID, right? And Gen Z is particularly on the electronics side, is partly leading that push of buying things now before they get, too expensive whenever this 90-day hiatus on tariffs or however long they take to kind of sort of reach their peak. So we might see some retailers benefiting from that in the near term, but that's going to just be a bell curve that another cliff we'll see, months from now. So I don't know if that's a silver lining, but it's going to boost some retail sales for a month or two.
Pivoting to the other thing that everybody's talking about, and we don't have a lot of time, but I'm just curious, what are you seeing in your data in terms of consumer behavior related to the sort of biggest topic in the world of tech and business, which is AI?
A couple different ways I'll parse it out. The consumer, by and large, in aggregate, the collective populace, let's just call them, Americans, right? And not thinking about them through the lens of just consumers. They're still very skeptical, concerned. I think the fear of the potential risks of AI, and a lot of that's born of maybe the movies we all watched in the 80s and 90s and early 2000s. That overall concern, 74% of Americans are still characterize themselves as somewhat to very concerned about the negative impacts of AI, compared to 26% who are more positively inclined about it. Now, so that's a big, almost 3-to-1 difference between just negative fears, perceptions. It is improving. So the very concerned number has fallen 6 percentage points over the last year. The not concerned group has risen 5% over the last year. So I think as people are getting more comfortable with it, using the tools themselves, benefiting from some of the features and search and others, like it is warming them up, but we still have quite a long way to go. One place where it's definitely taking hold in a more positive way is at work. Just under half of employed Americans report using some form of AI, ChatGPT, the like, in their work, at least monthly. About 22% use it at least several times a week. So it's definitely taking hold from that sort of workplace productivity standpoint. But from sort of the broader consumer, there's still just a lot of suspicion, skepticism, and fear that will likely continue to suppress adoption of those things by consumers. But again, like I said, I think whether it's the PR and the marketing or just the familiarity with it, those numbers do seem to be improving, and pretty sharply over the last year.
Interesting. Well, maybe we'll check in with you again in a year or two on that one.
Well, I mean, check in with us next month. I mean, that's like with all this stuff we're talking about. I mean, I always tell everybody, I do a lot of client presentations on this stuff, and it's like, basically throw this presentation away after I send it to you, and I'll, because next week everything I told you today could be untrue, right? And AI, barring some bad catastrophic PR event or something, I expect to continue to go up and to the right, but it's just got a long way to go.
Got a long way to go.
It started in a tough spot, yeah.
All right, so last question before we let you go. You announced CivicScience advertising, which was a new approach, privacy-driven approach to and data-driven approach to advertising, particularly in the programmatic space, a couple of years ago. How has that gone, and what have you learned from doing that?
It's going exceedingly well. It will likely, by the end of the year, if not the end of the third quarter, surpass our core intelligence business in size at the rate it's growing. And the other business is growing too. Just that one is going to eclipse it by the end of the year. So, I think we believed we were onto something, and it seems by all accounts that we were. I think I've learned a few things. One about our business and one about the market. One is that it turns out asking people questions about what their intentions are to buy something is a really good signal that they're going to buy it, right? We don't have to guess. We don't have to assume because you bought something previously or you happen to search for something or that you're likely to be in the intent bucket. We just simply ask millions of people, how likely are you to buy blank in the next 30, 60, 90 days? And surprisingly, that's a great signal of purchase intent. So some of that seemed obvious, but of course we needed enough scale to prove that it worked. The second one is how valuable these kind of psychographic attributes that we capture, things we just talked about, tariff concerns, concerns about AI, political affiliation crossed with tariff concerns and economic sentiment and well-being, how those hopes and fears and wants and needs that we can learn by asking people questions, how valuable they are as targeting vectors for media, right? Baking that into a segmentation that, so much of advertising is powered by observed behavioral information because we have infinite amounts of it, right? And but there's a lot we can't observe from someone's behavior that we can only get by sort of tapping into their brain to understand the why behind their purchase. And really instrumenting that has turned out to be really effective in generating really high performance. The last thing is just, it's a difficult, the space is hard to operate in. There's a lot of competition, of course. There's a lot of competition out there that's given the industry a bad name in the way that they operate. So we spend a lot of time trying to convince people that, yes, we're privacy compliant. Yes, we're ethical in the way we collect data. Like even, people are inclined to not believe us. So that's a bit of an uphill climb. And then, look, the big agency holdcos have a lot of power, and navigating our way in and around that and through that is really hard to do. We've had a lot of success with companies that are buying their media in-house. working with more independent agencies or more, right? So those are some of the challenges that we've had to work our way through. And I think based on the growth we've seen so far this year and expect to see through the rest, we've maybe figured out our way around the landmines. But no, it's been extremely validating of a vision and philosophy that we thought could work. And so we still have a long way to go.
Congratulations. It's not easy to break into that business. And I'm really pleased to hear you say that. We have to stop now, but John, thank you so much for checking back in with us. And we will check in with you often.
All right.
Appreciate your time. Thanks for being on Signal.